And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Thursday. Michael Lebowitz joining me today as we get ready to wrap up the week. Second best trading day of the year, of the month, of the week, every week. Second best day of the week, Thursday, always. Love Thursdays. Friday's right around the corner, start of the weekend. A few things going on, of course, as we talked about yesterday, government now shut down, which will probably mean no BLS report tomorrow in terms of employment. We're supposed to get that tomorrow, so Mike and I are going to touch on, who really needs the employment report? We got plenty of other data. But speaking of economic data, the economic surprise index has turned up sharply recently, and that's kind of surprising. Again, we've talked about the weakness in the jobs reports and those type of things. Now remember that these economic surprises only means that the data is coming in a bit stronger than what the average economist was expecting. It's the surprise, right? It's like, oh, that was stronger than I thought. Doesn't mean it's great data. It just means it's stronger than expected. So in other words, if I was expecting a recession and I get zero growth, right, that's a surprise, right? It's not great data, but again, you kind of get the point. Well, that data has turned up rather sharply. And there's a very strong correlation between that economic surprise index and the strength of the dollar, as an example. And we've kind of talked about over the last couple of days that the dollar is very oversold, due for a rally. The economic surprise index is starting to price in stronger economic data. So maybe part of what's been kind of driving the markets is this, and again, it has been, is this expectation that both Fed rate cuts is going to lead to stronger economic activity, and that will help support earnings growth to support markets and current valuations. Speaking of valuations, though, as of yesterday, the market hit the highest valuation that we've had, and this is on a forward earnings basis. And so on a forward earnings basis, the market hit this highest valuation level we've seen since the turn of the century. So, we've talked previously about, dot-com bubble valuations. Only in 1999 were valuations higher than they are now. And they got a little bit higher, but not dramatically so. But this is where we are. And speaking of valuations, Cape Valuations, Shiller, which is the 10-year smooth average of earnings, that is now at 40 times. That peaked at 42 times earnings back at the turn of the century as well. So again, valuations obviously very elevated, and that's all subject to expectations from investors that earnings are going to catch up with the markets in the future. So we'll see what happens. But again, expectation, we talked about this at length yesterday, talking about the AI bubble and what's going on, and just the reality, just the reality is that earnings expectations are well ahead of probably what reality is going to turn out to be. But that's always the case. In the middle of kind of a market advance where, investors are just chasing any asset price higher, which is, currently kind of the process in the market momentarily, that typically leads to bigger reversions, because the only reason for that is that at some point, the reality of what is going to come out in terms of earnings growth tends to be a far different thing than what the expectations were, because in the heat of the moment, we just kind of keep ratcheting up our expectations to justify the current price levels in the markets. And that's okay. That's how markets work. And that's sentiment. That's why sentiment has a very high correlation to valuations in the short term, because valuations are a function of sentiment. I'm willing to overpay today because I think that earnings are going to get to this level next year. And then when I get to that fair valuation, I have to up that expectation for earnings to justify keeping buying stocks. So that's just the way the market works. You just have to understand that dynamic, and then eventually that reverses. But here's what you need to know before the bell this morning. Markets did set. Let's talk about expectations and sentiment. Markets hit an all-time high yesterday. So again, just continuing to kind of run along this kind of 20-day moving average that continues to be very, very good support across the board. Every time we do have dips that come back to that 20-day moving average, that continues to find support. And then the markets kind of rally off that. And that's been a repeated process really ever since that April low. And we've just come down, we touched that and continue to rally, and that keeps the bulls in place at this point. And that kind of dynamic continues to play out right now. Volatility remains very compressed. And as we move into October, as we talked about yesterday, moving to the seasonally strong period of the year, you've now started to get a lot of tailwinds for the markets into year end. But we did, yesterday hit that all-time high. Again, we're starting to see a little bit of rotation. We saw healthcare stocks actually outperforming a bit yesterday, which was very, very good. We haven't seen that in a while, but again, we're starting to see healthcare begin to pick up here a bit. And that's helping broaden out the market just a bit here, but it has been very much an AI chase at this point. Furthermore, markets continue to push back up into overbought conditions. Again, not surprising. So again, with markets kind of pushing up here, that will suggest that at some point you're going to get some type of short-term pullback. But any pullback here between now and year end should likely be bought, just as a function of that we are in that seasonally strong trend of the year. Now, talking about October tends to have a higher volatility. It runs about 18 on average. We're currently trading around 15, 16. So again, October tends to have higher volatility. You tend to get some volatility that, kind of looking back historically at the month of October, it's kind of a mixed bag. You have some positive Octobers, you have some negative Octobers. The average rate of return for October tends to be about 1%. But that 1% comes with an increased level of volatility. So you typically get some choppiness in the month of October. But the good news is that if October turns out to have any type of pullback, November tends to be exceptionally good. So again, just any pullback here that you get is going to provide an opportunity to get capital allocated to the markets for that kind of year-end push. Again, as we get into the last 2 months of the year, a couple of things to be paying attention to. There are some seasonal things that go on. If the market is doing very, very well in November, expect a pullback in the first couple of weeks of December. That's where mutual funds have to make all their annual distributions, capital gains, income, dividends, etc. And given the market performance this year, we could have some decent selling in that first couple of months as they distribute those capital gains from their portfolios and rebalance portfolios in December. So again, there's going to be a couple of opportunities this market may give you to get money allocated as we start that kind of year-end push to wrap up the year. Again, you have performance chasing to get into the year-end. We got year-end reporting, a lot of things. So a lot of pressure right now on hedge funds, professional managers in particular, to get allocations built up and participate. So again, just kind of pay attention to the markets here. Volatility remains low, as I said, but the trend is clearly bullish. Nothing to be overly concerned about at the moment. Excuse me. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, talk about who needs the BLS, who needs employment, and some other stuff. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Got a tickle in my throat this morning, so excuse me. All right, welcome back to the show. It is the Think Tank with Michael Lebowitz this morning. Got a few things to get into. Again, talking a little bit just a second ago about valuations. I just wanted to show you this kind of one chart that I posted this morning. This is the S&P. I was telling you, this is the S&P forward PE ratio. again, when you're taking a look at that, the forward PE is currently at 22 times 8. The long-term average, the 30-year average is 17. The KPE is currently at 39.8. Just we can round it up to 40, close enough after yesterday. 28.4 is the long-term average on that for this century. Now, again, when you look back historically, previous peaks pre-turn of the century were at 23 times earnings. So, again, that average, and I've written some articles about how since the turn of the century, because of all these monetary interventions, because of zero interest rates, all these other policies, we've raised the average PE ratio. So again, when you take a look back, and it depends over what period you're looking at, but over the last, since 1980, as an example, the average PE went from about 9 to about 15, 16, 17. And so depending on your time frame, so where you start to look, this kind of running bull market that we've had, from 1980, you had the kind of the flat period between 2000 and 2013, and then you've had this largest bull market in U.S. history now that started between 2009 and now. That's raised the average PE ratio on this long-term look. So when we talk about valuations being at 40 times earnings, you have to also understand that the median and the average PE has also been lifted because of all this monetary intervention. Dividend yields are at 1.5%. The long-term average is at 2%. So again, when you talk about equity risk premium, you're simply just not getting paid to own stocks right now. But again, we own them because they're going up. Earning yield spreads, which is interesting, is negative 0.6 versus a long-term average, 30-year average of a positive 0.7. So again, just from a valuation fundamental basis, there's very little value in the market. So you're strictly buying assets right now based on the idea that asset prices will continue to rally into the future. So just kind of something to keep in mind, just kind of temper expectations. But we're seeing this across all asset classes. We're seeing this in Bitcoin, we're seeing it in metals, we're seeing it in emerging markets, we're seeing it in international markets, small cap and mid cap. It pretty much doesn't matter what asset class you're buying right now, you're getting a rally in that asset class, which is also risky when all asset prices start to correlate. When we start to move all asset markets to one, that becomes a much more risky environment for the market. So, Mike, before we get to employment, your thoughts?
Yeah, look, valuations are very high, but I just want to point out that compare this to 2000. We have NVIDIA, we have Google, we have Microsoft. They are growing at massive growth rates. In the late 90s, we had similar companies, but they were not growing earnings. They were kind of pie in the sky at that point. We were going to have great earnings from those companies. So there's a slight difference. What's NVIDIA? 6-7% of the S&P 500?
Right.
They're trading at a forward PE of right around 30. So right off the bat, 7% of that S&P 500 is at 30, and we can debate it, but it's somewhat justified. If their earnings come in as expected, which they have been, they've been actually beating expectations. If they continue to grow, some of these companies are at relatively proper valuations. And we can look at price to earn, the PEG ratio, the price to earnings to growth. And NVIDIA is roughly 1.5. So the market is very overvalued as a whole, but comparing it to 1999 does have some faults. And you can make a case that 1999 was higher than we are today because these companies are actually producing earnings and showing growth versus expectation for earnings. So just something to keep in the back of your head. It's not apples to apples.
No, it's funny you actually said that because that's actually the subject of this weekend's newsletter is talking about this whole AI, kind of issue that's going on and comparing. There are a lot of similarities, and to your point, there's a lot of similarities back to 1999. In 1999, we had Pets.com, Global Crossing, and those were all banked upon this idea that these revenues were going to come, and you had a lot of deals getting done between companies like, okay, I'll give you, I'll give you access to services, and you guarantee that over the next, 5 years, you're going to use all my services that I give you for free today. Those type of things. We're doing all these type of deals, and they're all getting booked as revenue. And so, the problem is that, and this is what I was talking about in the opening segment, is that expectations for earnings, kept getting ratcheted up more and more and more. even though they hadn't come to fruition yet. And and to your point, there is a big difference today is that, let's just say the whole AI bubble completely falls apart, and that all this expectation for AI, everybody just wakes up tomorrow morning and says, we don't want AI. Just forget it ever happened. Well, Apple, Nvidia, Meta, Google, Microsoft, they'll certainly take a hit price-wise, but they're not going bankrupt over it. They've got their main business is outside of AI. Amazon is not an AI company. They're not solely dependent on AI. They're still going to be selling product, delivering product, all that type of stuff that was their business before AI was even a thing. Same thing for Microsoft, same thing for Meta. Meta will go back to doing ads and social media. Google will go back to selling ads and YouTube channels. So the big difference is that back in the late 90s, these companies were solely dependent on this idea that this internet was going to be a thing, and they were booking revenue and growth on expectations to come. But to your point, there's a very big difference today. Microsoft, Google, Amazon, et cetera, may get cut in half, but they're not going out of business.
Right. And I think some of those companies, the WorldComs and the other ones that went bankrupt,
right?
They would have survived had they had enough runway. The spending that ultimately would have come back to them would have been enough. And some of those valuations probably would never have been justified. But like some of these companies, even if AI goes away, they'd still be around. So it's also a question of timing. When do all these investments pay off?
Right.
And
well, there was also
next year.
Yeah, but true. But with WorldCom, there was also the fraud thing.
There were other things. There was a little company called Enron too that got involved.
Yeah. So outside of the fraud thing, if they would have had enough runway, they would have been okay.
Global Crossing too.
Yeah.
Global Crossing's another one.
Exactly. But again, I think there's two takeaways from this is that, yes, there's certainly a lot of excitement around AI. But for people that are comparing the current AI situation to the dot-com bubble, there are a lot of differences that you have to keep in mind. And I'm not saying that you can't have if you cut Microsoft, Amazon, Apple, Meta in half, price-wise, it's going to be a very devastating shock to the markets. That's because they have such a big weight. And so there's a lot of expectations, and just like in the late 90s, there's a lot of expectations in the bubble that, back then it's like, earnings are just going to kind of go off to the moon. These are going to be the next companies. and I was saying this morning, we have a lot of expectations for earnings growth. And so the risk to investors is that, and this comes back to valuations, all valuations tell you in the short term is sentiment. Investor sentiment is very bullish. And as investor sentiment is what's pushing valuations higher on the expectation that the earnings growth, like Mike was talking about with NVIDIA, is going to come to fruition. The risk is what happens if it disappoints even mildly. That's the risk to investors. Again, to have a 20 or 30% correction in the markets from these levels would, put it in perspective. To go back to where we were at the April lows is a 25% correction-ish, right? 25, 26, 27. To have a 25% correction in the markets would only require NVIDIA to slightly miss earnings growth expectations, or to guide down, or for Microsoft and Amazon to cut back CapEx, say, hey, you know what? We're not going to be spending as much on CapEx as we thought because of A, B, or C reasons. Any disappointment to the narrative, you could have a correction back towards those April lows. That would still not be a bear market, mind you, because you would still be in a very bullish trend from the market, particularly since the October 2022 lows. You'd be in a very bullish trend. But going all the way back to 2009, you would still be in the bull trend. So you would simply be having a correction within a bullish trending market, but it's 25, 26% to get there. That's not going to be real pleasant to work your way through. And that won't require a lot.
Here's a little thought, Lance, and I don't know how we could do this, but what I would really love to see is something like the median PE today versus 1999, or take out the middle 100 companies by market cap of the S&P 500, and what's that average price to earnings versus what it was in 99. So you're looking at more mainstream companies. Are they overvalued? And I think there too, what you're going to find is there was much more overvaluation in 1999 than today. The reason we look so similar is because you have 5 or 6 companies that have very high PEs. But that's something we can talk about. How do you get median PEs?
Well, hold on a second though. You say that, right? You do have 5 or 6 companies with very high PEs that make up the biggest chunk of the index, right? But you have a lot of other companies with very high PEs, Palantir,
you
Palo
do.
Alto. I mean, you start digging through the list of the S&P 500 companies, particularly on the tech side of the ledger, there's a lot of companies with very high PEs. And again, there's nothing wrong with that as long as the earnings growth is justifying those valuation levels. And so far, so good that that's certainly been the case. But, we're starting to see some of those kind of similar behaviors. And this is the subject of this weekend's newsletter is, you have Oracle investing $100 billion into NVIDIA, which is investing $100 billion into OpenAI, which is investing $100 billion back into Oracle, and you just have this circular, infinite money glitch going on within companies. And that's, again, nothing wrong with that as long as the future turns out exactly the way everybody's expecting it to. And again, the whole point of the conversation is just simply valuations are high. That's a function of sentiment. Just be aware that increases the risk of a more substantial drawdown in the markets. Again, I'm not talking about a bear market crash. I'm not talking about a financial crisis. I'm not talking about a dot-com crash. All I'm saying is that those expectations about the future are so elevated that increases the risk of a decent drawdown in the markets at some point for whatever reason. And again, that's just simply would come from a disappointment. And again, we're about to go into earnings. I don't expect anything. I'm not saying we're about to have a big disappointment in earnings in October. I'm not saying that at all. I'm just saying that at some point in the future, that's what your risk is, and at least worth paying attention to.
Right. Valuations are high, and I'm not backing off that. The point is just a comparison to 99.
Yeah. Absolutely.
And right. So we're good.
So let's shift our gears a little bit here towards the government shutdown. Of course, this is the big news this week. It's like, we shut down the government. This is the 4,788th shutdown since 2008. I don't know. We've had some fairly long shutdowns historically, and shutdowns are not a new thing. I posted a chart this morning of shutdowns versus the S&P 500. And again, this is kind of one of the things, it's like, this isn't a new thing. These have been going on since the 70s. And in fact, kind of like recessions, they used to happen a whole lot more often than they happen now, surprisingly. But this is a chart of S&P 500. So the red bars are whenever we've shut down the government, and then versus the S&P. So again, these aren't a new thing. Typically these don't result in major sell-offs in markets. They don't cause bear markets, those type of things. They tend to be fairly short-lived. Some are very short. The longest one we've had was 34 days. That was in 2018. That was the longest on record. And they get resolved. And then we go on with life for whatever that is. So again, but, as we talked about earlier this week, I think on Monday, we covered this, the things that occur during a shutdown are that non-essential workers, which are people not involved with either national security, national defense, protection of property, personal safety, those type of things, they get furloughed. And they just get to go home. They get a paid vacation for a couple of weeks until we get this resolved, and they all come back to work and they all get their pay. Everybody else stays at work. So that equates to about 900,000 workers, government-wise, that get laid off. Everybody else stays at jobs. Interest payments get paid. There's no risk of default on debt, as we said earlier this week. No Social Security checks go out. Military gets paid. Everybody on the mandatory side of the spending budget still gets their money. So there's nothing. So this isn't a big event, right? It's more of a news headline event. It's great for media headlines to navigate all this stuff. But one of the big side effects of this is that the divisions of the government, like the Bureau of Labor Statistics, they do get shut down, and so we don't get reports. So we won't get if we stay shut down for a couple of weeks, we won't get an inflation report. We won't have an employment report on Friday, And, this has got the markets worried. It's like, oh my gosh, what are we going to do without this all important BLS report? I mean, even though we all laugh at it and we all chastise the inflation report and say it's all complete crap, and we keep telling everybody that the BLS report is completely wrong and has nothing to do with the reality, we can't live without this report, right? So everybody's all worried about Friday. We're not going to have this BLS report. And oh my gosh, what are we going to do? But we did get ADP yesterday, which kind of confirmed what we already knew, that the economy is fairly weak on the employment side of the ledger. And the BLS employment report has already been confirming that. ADP came in yesterday to negative, correct me, Mike, I think it was negative 35,000 jobs for
I want to say
month.
Yeah, 32, I think.
32.
Minus 32.
Yeah, so it was negative 32,000 jobs. Now, again, the correlation between ADP and the BLS has broken in the last few years. They used to be much more correlated previously, but in the last 5 years or so, that correlation has really kind of broken a bit, but they do trend together. And so if ADP is suggesting a month of job losses, it would likely translate, if we did get an employment report on Friday, it would likely suggest that the employment report on Friday would be fairly weak. And again, we've already seen that weakness in the employment report, but that would probably, kind of reflect that as well on Friday. Again, it's not the end of the world. We won't get a report, but ADP is already suggesting what we already knew, is that employment is slowing down.
Well, and one thing that's a little concerning is that, yes, the correlation is broke down, but when you factor in all the BLS revisions, that correlation becomes much better. So what it's telling you is that ADP is kind of leading, and then in time, BLS will catch up to it.
Right.
Once you get these revisions, which take years, some of them take a couple of years to come through the system. And also yesterday, just as important, they revised the prior month down by 50-something thousand jobs to minus 3,000. So now 3 of the last 4 months have been negative. That's concerning for an economy that should be growing jobs at about 150 to 175,000. So this is the interesting point. We don't have the BLS, and for the last few months, 6 months, we've been harping that that's okay. The unemployment numbers have been faulty. They've been heavily revised. There's a lot of other data out there. Well, now everyone gets to see that there's other data out there, right? So we got ADP. Paychecks also came out yesterday. They were negative. Paychecks primarily does small companies. So they kind of confirmed what ADP said. And ADP said their small and medium-sized businesses lost jobs, larger companies gained slightly. So Paychecks and ADP, two private sector companies, are both telling you that there are now job losses. JOLTS came out on, Tuesday or Wednesday? And JOLTS is a tough figure. The headline is job openings, and that's somewhat faulty because we know a lot of companies post job openings with little intention of hiring. They're just trying to keep their roster of potential employees up there, of resumes in their system up there. And it's become so much easier. All these new companies like Indeed are out there. So it's very easy to post jobs and not hire. Nonetheless, we can look at the trend. Are there more job openings or less job openings? And that trend ever since 2021 has been declining, and now it's taking a further step lower. The other component of that is job openings versus the number of unemployed, and that's finally gone below 1. The last time it did that was in 2017. It was running at about 1.25. So there were more job openings than jobs. Now there's more job openings than unemployed people. Now there's more unemployed than job openings. So even if all those job openings got filled, which is never going to happen, there's still unemployed people.
Right. Which is a big reversal. Remember, that was one thing that, Jerome Powell was kind of always referring to during 2020, 2021 is like, oh, we have this really great, jobs market. We have, many more job openings than we have unemployment people. So we have a very tight labor market. And that was one of the reasons he was hiking interest rates and all this. So again, that the part of that tailwind that was helping the Fed kind of support raising interest rates because this labor market that we had, and they were worried about potential wage inflation, those type of things. has completely reversed. And unfortunately, we never saw the massive wage inflation everybody was worried about. And now we're starting to see wage deflation, which will become more problematic. And again, as we talked about the other day, take a look at the labor input of wages into the system. Those are declining, and suggest that inflation is going to decline in the future if that doesn't start to reverse itself.
Right, and we also know that the quits rate, which is also in JOLTS, is very low. And when I say at 10-year lows, quits rate tells you how many people are quitting on their own. Right. So if you're quitting on your own, most likely it's because you're very confident you can get another job, probably a higher paying job, a job you like more, something that offers more benefits. Well, when people aren't quitting, it means they're not comfortable that they can get a new job, or they're not comfortable retiring because they don't have enough money. So that's telling as well. So, and Lance, the other thing that you can't really hide is just the IRS. They withhold money from our paychecks every time we get a paycheck. So you can look at IRS data, and this year is very different than the prior few years. And we share all this stuff in today's commentary. So if you want to see these graphs, check out today's commentary. But what you can see is that this year's IRS withholding is virtually on top of last year's. If there's really job growth of 100, 200,000 jobs, every year should be higher than the prior year by a decent amount, because they are withholding more money. And we take out wage inflation from that. So it's a much better gauge of employment. And, that's something that can't be hidden. And today we're going to get jobless claims. That should be interesting, because we've seen continuing claims rise, but not too concerning. But initial jobless claims, we had that 1 week bump about a month ago, a few weeks ago, but it really hasn't pointed to some of the weakness we're seeing in everything else. So, again, there's a lot of gauges out there, and we're not beholden to the BLS for their monthly report.
But again, the market is, though, right? I mean, the whole driver of this market over the last, really kind of 2-3 years in particular has been market's going up. Why is the market going up? Because the Fed's going to cut rates. Why is the Fed going to cut rates? Well, we're looking at every single employment report, every single inflation report, and as those come out, it's like, what does that mean for the Fed? And so now, Mike, I think the bigger concern is how on earth is the Federal Reserve going to make any type of policy decision if they don't have the employment report, and much less a CPI report? I mean, they obviously have no other data that they can look at, because they are solely dependent on these two reports that come out of the government.
Which raises the question of what are those 400 or 500 PhDs doing other than waiting for the BLS report? I mean, if an idiot like me can uncover some of this stuff, you would think some PhDs would be able to do a much better job of it. But
I know. Well, and of course, obviously, we're a little tongue in cheek here, but it's amazing though. The whole market has been tied to these reports, and every single report that comes out. What does that mean for the Fed? Is the Fed going to cut rates more? Are they going to cut rates less? Are they going to hike rates? What does all this mean? And now all of a sudden, and this is kind of the fear of the media. And I'm going to say it's the fear of the media, because the market doesn't care. Market's up again today. NASDAQ's going to open up about 100 points this morning. S&P's going to be up about 15 at the open. So markets don't care. Markets are all into the bullish trend. It's completely fine. But the media is, just breathless over this idea, this prospect of not having these government reports to rely on.
Right. And look, here's the upside. There's less government spending, too. So this should be good for it's bad for employment, but good for the deficit. And look, at the end of the day, they're going to solve this, whether it's a week, a day, later today, whatever it's going to be. It's going to be a very, very short period of time. It'll be back to business as usual. Both sides of the political spectrum will say, we did great, didn't we? Look at us. And it'll be business as usual.
Yeah. So let's switch gears here a little bit and then talk about Stephen Miran. You've got an article that you published Wednesday on this as well, just talking a little bit about, kind of he's the outlier of this, and he's pushing for many more rate cuts than kind of the rest of them. But you kind of make the case that on a technical basis, there may be something to his argument.
Yeah, so it's important to follow him because he's the new guy. right? And he's the one that is pushing for much lower rates. Everyone else is sort of in the same camp. Some want lower rates, some think they should stay the same. There's one that thinks rates should be higher, and then you got Stephen Miran who thinks rates should be much lower than where they are.
Yeah, and just to put this in context, here's the dot plot from the latest Fed meeting. And these dot plots, they show kind of where each voting member has said where rates should be. And you'll notice on this dot plot that Stephen Miran is the oddball on this. He's the one that's at the very bottom of the list. But, again, this is, to Mike, to your point, he's the one that's pushing for a lot lower rates relative to all the other voting Fed members.
Right. So what was important was, let's listen to what he has to say now that he's on the FOMC committee. He's a voting member. And remember, he also dissented. He wanted a 50 basis point cut. And, honestly, I thought he could have voted for 75 or 100 based on his views. But after the meeting, he came out with a speech to the, I believe it was the New York Economic Club. Mm-hmm. And he really told you why he thinks rates should be lower. So kind of at a high level, one of them is just he thinks the inflation rate is higher than what it is. And we've been preaching this for a long time. 30-40% of CPI is shelter prices. It's rent and imputed rents. And we know for a fact, even based on Fed data, that the CPI and PCE are too high, that they are in time coming down because basically what they do is they do surveys. What's your rent today? What was it last month? And for most people, the rent today is the same as it was last month, except for that 1 month where they have to re-up, re-sign their lease, or they move and they get a new lease. Well, what some of these Zillow and Apartment.com and even the Cleveland Fed do is they say, what's the rent index if you just look at people that are re-upping, re-signing leases, or moving this month? That's the same thing we do with every other thing in CPI. What's the price of new cars today? They don't ask people what they paid for their car 3 years ago, but they do it with rent. And because of that, the CPI number is probably overstated by 0.5%, maybe more. Mm-hmm. So Stephen Miran points that out right off the bat.
So here, real quick, let me just show you a chart of this, so everybody can kind of understand what we're talking about. This is the new tenant rent index versus
by the Cleveland Fed, and versus the CPI shelter year-over-year percentage change. And you can see that there's a decent correlation between these two indexes, but the new tenant rent index has literally fallen off a cliff, which suggests that inflation has yet to catch up with what's going on with actual rentals. And you can really see the lag if you go back and look at like 2008, 9, 10. Mm-hmm. You could see how the blue line falls first, recovers first, and then the goldish line follows afterwards.
Yeah, correct.
The other one he talks about is immigration. So when when we talk about rates, it's a combination of inflation and economic growth. Economic growth is productivity and demographics. So immigration policy and the baby boomers retiring is a big deal. So he thinks that because of these new immigration policies, we're going to, our population growth will not be what it was as it was the last few years, that shaves another 0.5% off Fed funds, give or take a little. So right off the bat, between inflation and immigration, he's arguing for 1%. Then he goes into some other issues that, productivity should be increased, deregulation. That's a positive. That should argue for slightly higher growth rates. But then he says there's going to be less deficits. More money is going to be put into the private sector instead of the public sector borrowing. So basically, when you work through kind of all his math, mm-hmm. you get to a point where Fed funds should be much closer to 2% than 4% where they are now.
Yeah, and part of this goes back to the natural rate of interest, which you actually had a chart on this in your article. But there's kind of two things. One, you've got the natural rate of interest, and you've got R-star. But you can see that the natural rate of interest, where the model is, suggests that rates should be lower than where they are, and that's kind of his point. To where when we start looking at these underlying economic activities that are going on, whether it's inflation or whether it's, immigration or employment, whatever, that all affects where that natural rate of interest should be. And again, to your point, that should be, and then to his point, that should be lower than where it is now.
Right. I think he's arguing for a lower rate than I would argue, but the point is that rates are too high. And he makes a very good point, and it's not just words. He quantifies it. If you go through his paper, if you go on our website, there's a link to his paper if you want to get pretty wonky, or you can look at our summary, which is wonky but less wonky. and we break down all the pluses and minuses to the rate, where he gets to and how he gets there.
But I guess the question is, ultimately, is he right, and is everybody else kind of on the Fed wrong, or is he potentially overstating kind of what it kind of seems obvious now, but not potentially, looking at if we do get this resurgence of economic activity, which Wall Street's highly hoping for, if we do get some type of inflation push, from stronger economic activity. Does that reverse his arguments?
Right. And some of this is forward looking. And the more hawkish members of the Fed are also forward looking. And they're saying, look, the stock market's doing great. Atlanta Fed GDP is telling us we're going to come in close to 4% economic growth. We're still scared that tariffs are going to cause inflation. Why would we lower rates today?
Right.
And look, they can just as easily quantify that as well into numbers that tell you the Fed funds rate is right now perfectly justified. And I actually actually in his table, he shows that. There's a table that he produces, and I show as well. So
let me see. Let me find that table real quick.
I think it's towards the bottom of the article.
It shows the Taylor rule, et cetera. Hold on. You got it here. Okay, if you want to explain it.
Yes.
These are basically the forces. This table shows the forces that are affecting, the Fed funds rate. So go ahead, Mike.
Yeah, so the bottom line is using the standard Taylor rule and the balanced approach Taylor rule. That's the one Janet Yellen preferred. Fed funds should be between 426 and 396. Right now, they're between 4.25 and 4. So according to those kind of rules that have been around since, what's the Taylor rule, in the 70s, late 70s, early 80s, Fed funds are where they should be. But when you work through all these things, deregulation, rent disinflation, population growth, trade policy, you kind of get to 250 to 2%. And that's his argument, whereas most of the other FOMC members are kind of on that top line. These tools have worked so well for us in the past. We're going to keep using these tools because we're always right on monetary policy. Tongue in cheek there as well.
Exactly.
Right. But so both sides can make good arguments, and they're all very smart people. And like I said, they're backed by hundreds of PhDs that are smart, and they're looking at incredibly more data than we are. But, the bottom line is tariffs matter. What's going to happen with inflation? When do shelter prices really start dragging CPI down? When do the higher tariffs start inducing layoffs? And we are seeing that. And what's the impact on prices and growth and demographic changes? Not just immigration policy, but the baby boomers starting to retire. All that is going to have a big impact on the economy and ultimately interest rates. Right. So stay tuned.
Yeah, no, and again, you're right. And again, there's 400 PhDs that run around the Fed halls. And the problem, though, is that they get caught into groupthink, as is always the case within the organization. So they all kind of start thinking like, having the same conversations at the water fountain. So, oh yeah, this data says this data says that. That all gets modeled into this. But this is why historically the Fed is always late to making monetary policy changes, because of that groupthink. Right now, kind of that groupthink is tariffs are going to cause inflation, and that hasn't shown up yet. And that may get well outweighed. Tariffs will get well outweighed by what goes on in the home sector, because 40% of the CPI is homeowners equivalent rent and housing. So, it doesn't really matter what you do with tariffs. It's going to get outweighed by what's going on the homeowners equivalent rent side of that index. But again, that kind of gets overlooked in the heat of the moment by all these PhDs and by the Fed, who's getting fed this information by this group of PhDs, saying this is our concern over tariffs, and this could potentially be the case. And again, that's why historically we go back and look when the Fed has taken action. It's always kind of after the fact.
Well, and it's also the other thing, and Powell mentioned this, was goods prices are most heavily affected by tariffs, right? But service prices aren't. And service prices have been still trending lower. Goods prices have gone higher because of tariffs. But service sector is what, 2/3, 3/4 of the economy? So when you do the math, service prices continuing to trend lower, the growth rate trending lower, is offsetting most or all of that goods inflation as well. So you have a lot of factors at play, and we're starting to get to the point where that initial tariff bump is going to start fading, and inflation at a minimum should stabilize here and probably start declining, unless of course we get a resurgence in economic growth.
Right. And that's the big question into 2026 is, will AI, again, if you take a look at the spending that's coming in from AI, in particular the build out of data centers, the infrastructure, those type of things, that's creating, without that impact, we would have virtually very low economic growth rates right now. We'd probably be around 0.5% economic growth versus pushing 2%. The question is can that continue into next year, and can it be enough to offset the drag of rising unemployment potentially caused by AI, right? So as more and more companies, we're starting to see more and more companies. Chevron just announced layoffs. ExxonMobil's going to lay off 2,000 people. We're seeing more and more of that, and a lot of this is they're starting to cut staff as AI is starting to replace jobs. So again, this productivity miracle coming from AI also potentially has a impact on one of the most important drivers of the economy, which is employment, which provides the ability to have incomes to purchase and consume with, which is 68% of the economy. So, there's a lot of offsets going into next year, that this hope for productivity spending and build out and all this stuff that's going to come from AI may get offset by the negative impacts of employment changes.
Yeah. In other words, there's a lot of balls in the air.
Yeah.
Stay tuned.
Yeah. So, all right. Any closing comments for the day, Mike? Anything you're worried about, thinking about?
There's a lot to be worried about, but the market has been pretty resilient. When you started, you went over the graph and you showed the MACD.
Yep.
That's one of the most amazing MACD lines. It's just flatlining, trending slightly lower, but there's no oscillation in it.
Right.
So, I think that's telling you we're on a nice, smooth path. Doesn't mean it's going to continue, but it's just very interesting to me how there's all this stuff going on in the world, politically, economically, with the employment market really showing signs of weakness, and the market is just humming along as if nothing's going on. So be careful, because it is, with valuations, it is concerning. But that's also the trend, and that's the glide path we're on right now.
I think that's my biggest concern is that there's just so much complacency built into the markets that, what my worry is that we wake up one day and this market's down 3, 4, 5% because of nothing. It'll just be what would normally be a non-event will turn into a much sharper correction, over 1 or 2 days, that kind of take investors by surprise, simply because there's so much complacency in the market. We've talked about before that sellers live higher, buyers live lower, and right now you've got to keep dragging the market up here to get somebody to say, okay, fine, I'll sell you my shares of Amazon or whatever it is. You got to keep dragging that price higher to get them there. But when it comes time for somebody to want to buy, they're like, oh yeah, I'll buy that, but it's going to be a lot lower. And that's what creates these kind of air pockets in the gap, kind of when they occur, is like one day you wake up and the market's down sharply, and that's that air pocket where buyers are sitting a lot lower than where the sellers are right now.
And just to tag on to that, I think what will be very important is if hypothetically we fall 5% today, buy the dip will be coming right back in, right?
Oh yeah.
The question will be, can they buy the dip back to the highs, or do they falter? Do they set a lower high and then do the bears start to gain power again? And that's when we can see if this is a longer term consolidation, start of a bearish trend, or if we set new highs, it's, off to that glide path again. So that'll be an important tool for us to see where the market is as well.
Exactly. All right, that wraps up the show for the day. Mike, thank you so much. Be sure to buy the website. Mike's article talking about Stephen Miran is on the website now, along with our latest daily market commentary, talking about everything from kimonos to Bitcoin. It's all there on the website, realinvestmentadvice.com. Tomorrow, of course, we'll have another article out tomorrow talking about the economy. On Saturday, talking about the AI bubble in our newsletter. So make sure you're subscribed for the newsletter. We email that directly to you on Saturday, realinvestmentadvice.com. Be sure and like and subscribe to the channel. Helps us a whole lot. And we'll see you next time on The Real Investment Show.